Hello, everyone. This is Mike from Marlin Financial Advisors. I'm going to go ahead and revisit Vanguard's outlook for financial markets. This was based on June 30th numbers, but it has been looked at from Vanguard since September 14th. So let's take a look at what basically Vanguard thinks will happen in the financial markets over the next 10 years, right? So this video, on my last video, I discussed kind of each piece. I went over each piece briefly. This video, I'm going to talk about more maybe constructing a portfolio for retirees or soon to be retired, or maybe lower risk investors also, because it's going to have a high amount of fixed income. So first, I'm going to go ahead and annotate, and I'm going to put down, we're going to do a 50-50 portfolio for simplicity. If you want to be more risky, probably put a little bit more in equities than bonds, and vice versa. But let's just keep it like that for simplicity. And let's review some of the highlights here. I also have on the left here, I have basically an ETF when available for each of these sectors. So you can actually go to Vanguard and look at these if you want to. You can obviously use any other fund company. They'll all have similar ETFs. But since it's Vanguard's data, I figured I would use Vanguard's ETFs or mutual funds, right? There's a mutual fund down here for money market mutual fund, another mutual fund here for high yield debt, high yield corporate debt. But most of the time it was ETFs. And then I actually give you two options in one spot here. But okay, let's look at it. So basically, in summary, I don't like international, so I'm not going to put any money in international. If you want to hear my rant on that, go to my last video. But let's move on from there. Basically, we're going to overweight value, and this is actually probably going to be the main piece of your portfolio in your equity piece right out of that 50. I would say possibly 40 there. Growth, I don't think is going to do good, so get rid of it. Why have it? Large cap, that's fine. You could also maybe just do, if you want to take a more conservative, balanced route, you could just do large cap instead of value, because then you get value and growth and take, a more conservative route. But, what's the fun in that? Let's do it based on their data. Why not? So, basically their data and my thoughts. Large cap, small cap, maybe we'll do a little bit there, and we'll do a little bit of REITs. What about like 10, 5, good Lord, and 35 to round out. Ooh. Sorry, I'm drawing up my mouse here. So that's I think what I would do. Do a little bit extra. This let me talk about these funds right here for a second. VF to VA is a total market value. So it has large, medium, and small caps. So we only need to add a little bit of small cap exposure to it to overweight small cap a little bit, right? And honestly, the volatility is so high on small cap, you really don't even need to add it if you want to. But you could possibly add like 5 or 10% small cap. I think probably REITs have done decently well. They're not doing well right now because rates are high, but I think they'll bounce back when rates fall. So I like adding in a little exposure, let's say 10% there. And then VYM is the Vanguard high dividend fund. So I kind of consider that value too, more stable companies that are producing high dividends. You could also add in like an SCHD or anything that's kind of a high dividend yielding company for equities. No cover call ETFs, but a standard just high dividend yield fund could work there too. That can kind of take place of the value piece. And if it doesn't have any small cap exposure, maybe you add a little more small cap exposure. But I don't think that's bad either way. And you could probably just ignore the small cap if you really wanted to. And bonds. This is the nice part about where we are right now in history is bonds are probably going to do quite well. I mean, if you just look at what they think equities are going to do compared to bonds, bonds are relatively competitive. So for you conservative investors, you're going to have a great decade here in theory based on Vanguard's information here. So what are good options here? You could just do a simple aggregate bond and do all 50% there. I don't believe in international bonds because they provide no benefit to domestic bonds at all. Because they just provide fixed income. So there's no like upside growth potential. All you're probably going to get is Argentina's going to default on its debt again, and it's going to kill you. Like, that's just what I think about it. I would just stick with the U.S. because we know the U.S. economy the most. Treasuries, you could just do treasuries. You could do, I guess what I would recommend. Man, what would I say? I guess I'd say I would keep either aggregate bond or treasuries, and then you could maybe sprinkle in some high yield corporates. If you're worried about inflation, put in tips or something, and you can probably have some in cash too. All good examples. I probably wouldn't do emerging market debt. I don't think I would do. I don't really care for credit debt. I would honestly just do treasuries if it was me. But those other options, there's definitely some other options there. But I mean, for me, it would pretty much be this right here. And this is an intermediate term, so 5 to 8 year treasury bonds. You can also go and buy bonds, CDs. CDs would work too. Same thing. You could buy CDs or treasuries. I like the lowest risk bonds there are out there, with no basically corporate risk or credit risk, I guess you could call it. And I like medium term. I don't like long term. I just think there's a lot more risk there with rates moving. And then you could also, if you don't understand how bond funds work with relation to interest rates going up and down, then just buy individual bonds. Because if you buy a 10-year treasury that's paying 4 1/3 right now, it will pay you the interest and your principal that you're due. The value of the bond might change, but it will pay you that interest if you hold it till maturity, and it will pay your principal back, right? So that kind of makes bond investing a bit simpler if you just wanted to do CDs or treasuries or something like that. And if you wanted to sprinkle in some high yield corporate, what else? Emerging market sovereigns. You could have some just in cash. You could also just ride the yield curve down where you just keep everything in cash. And then you just get the going rate until there's another better option, or you can lock in higher rates for long term, right? That's basically your options right there. But let's do that. Let's say we do that just for the fun of it. Why not? Let's go off Vanguard's recommendations. I'm gonna go 40 or CDs, right? CDs are an option. Ooh, man, that's hard. CDs, and then I'm gonna go 5 here and 5 here to make it fun, or you could just do 50 here, up here, right? And then obviously lower risk investors, you can change this weighting. Higher risk investors, you can change that weighting, or you can do whatever you'd like. I mean, this is just kind of a interesting thought process here, but it's kind of interesting to go over what Vanguard's thinking, kind of model a portfolio around that. If you have any questions, let me know, and take care.